For years, we were told that silver trades in a free and fair market, that price discovery happens transparently, that futures exchanges reflect real supply and demand. But what if I told you that one simple price gap between two major exchanges quietly exposed one of the biggest manipulations in the global silver market, a gap so large, so persistent, that it shattered the illusion of a single global price? Because when silver trades at one price in New York and a very different price in Shanghai at the exact same time, something is broken. And today, we're going to explain why the CME versus Shanghai silver price gap didn't just raise eyebrows, expose the system. Before we go any further, if you want clear, honest breakdowns of what's really happening in the silver market, global finance, and hard assets, make sure you like this video and subscribe to Global Silver Truth. This channel exists for one reason only: to cut through the noise and explain what the mainstream refuses to talk about. If that sounds valuable to you, hit subscribe now so you don't miss what's coming next. Now let's slow this down and really understand what happened, because this story didn't start with conspiracy theories. It started with math. It started with numbers that didn't line up. The CME, based in the United States, is supposed to be one of the most important price discovery mechanisms for silver in the world. Futures contracts traded there set the benchmark price used globally. At the same time, the Shanghai Futures Exchange represents physical demand from the largest silver-consuming region on Earth. In theory, these prices should track closely. Not perfectly, but close enough that arbitrage keeps them aligned. That's how free markets are supposed to work. But instead, what traders began to notice was something strange. Shanghai silver prices started trading consistently higher than CME prices. Not by pennies, not briefly, but by amounts large enough to matter, large enough to signal real physical demand. And most importantly, large enough to persist. That persistence is the key. Because in a real free market, price gaps don't just sit there. They get closed by arbitrage. Traders buy the cheaper market, sell the expensive one, and the gap disappears. Unless something prevents that from happening, and that's where the story gets uncomfortable. The CME is primarily a paper market. Most contracts never result in physical delivery. They are rolled, settled in cash, or offset before expiration. Shanghai, on the other hand, is far more physical. Contracts there are backed by actual metal, stored in approved vaults, with delivery being a real expectation. When physical demand tightens, Shanghai prices respond quickly. When supply is constrained, premiums appear. And that's exactly what we started to see. While Western markets insisted silver was abundant, calm, and under control, the Shanghai price told a very different story. It signaled scarcity, it signaled urgency, it signaled stress. And the wider that gap grew, the harder it became to explain away. Now think about what that means. If the CME price is lower, but physical buyers in Asia are willing to pay more, then the paper price is not reflecting reality. It's reflecting leverage. It's reflecting positioning. It's reflecting financial engineering, not metal moving from one hand to another. This is where manipulation enters the conversation, not as an accusation, but as a structural outcome. When a small amount of physical silver supports a massive amount of paper contracts, price can be influenced without metal ever changing hands. Large players can sell futures aggressively, push prices down, and create the illusion of supply. Meanwhile, physical buyers elsewhere are forced to pay more because they know what's actually available. The CME versus Shanghai gap didn't appear overnight. It grew quietly. At first, it was ignored. Then it was explained away as currency differences, local demand quirks, or temporary dislocations. But those explanations stopped working when the gap refused to close, because currencies fluctuate daily, yet the premium stayed. Local demand shifts seasonally, yet the premium stayed. Logistics normalize, yet the premium stayed. That's when more people started paying attention. And here's the part most people miss. This wasn't just about silver, it was about trust. If the world's benchmark silver price is set in a market where physical delivery is optional, what happens when physical demand finally overwhelms paper supply? The answer is simple. Prices disconnect. And once that happens, confidence breaks. You could see the stress building. Open interest remained high even as vault inventory stagnated or declined. Delivery requests increased at key moments. Margin hikes were introduced, not to stabilize volatility, but to force weak hands out. And yet, silver kept coming back. Because the underlying problem wasn't speculation, it was availability. Shanghai didn't care about narratives, it cared about ounces. It priced silver accordingly. This is why the price gap mattered so much. It exposed two different realities. One market trading promises, another trading metal. One dominated by financial leverage, the other by industrial and strategic demand. And when those two realities collide, the illusion can't survive forever. At Global Silver Truth, we've been tracking this divergence closely because it tells us something deeper. It tells us that the silver market is no longer unified. It's fractured. Fractured markets don't stay stable for long. Ask yourself this. If silver is truly abundant, why would buyers in Asia consistently pay more? If inventories are healthy, why would physical premiums expand? If futures prices are honest, why would they fail to pull physical prices down with them? The only logical answer is that futures prices are being suppressed relative to real demand. Now, suppression doesn't mean a secret meeting in a dark room. It means a system designed around leverage, liquidity, and confidence management. It means rules that allow unlimited paper supply to meet limited physical demand. It means price discovery that favors volume over delivery. And that system worked, until it didn't. Because when physical demand grows faster than paper credibility, the gap widens. The wider it gets, the harder it is to control. Shanghai didn't break the silver market. It revealed it. This is also why governments and institutions quietly watch these spreads. They know that persistent price gaps are early warning signals, signals that supply chains are tight, signals that strategic metals are being accumulated, signals that paper benchmarks may fail under stress. And silver is not just another commodity. It's a monetary metal. It's an industrial metal, a strategic resource. It sits at the intersection of finance, technology, and energy. When its pricing system fractures, it tells us something is wrong with the broader financial architecture. The CME versus Shanghai gap wasn't a headline event. It was a slow leak. Slow leaks are the most dangerous because they're ignored until pressure builds too high. If you're still watching this video, you already understand that silver doesn't move like stocks. It doesn't respond to headlines the same way. It responds to trust. Trust is fragile. As this gap persisted, more physical buyers began bypassing Western pricing entirely. Long-term contracts were negotiated off exchange. Strategic stockpiling increased. Vault withdrawals became more visible. And suddenly, the idea that silver price discovery happens only in New York started to look outdated. That's the real exposure. It's not manipulation as a scandal, but manipulation as a system reaching its limits. And here's the most important part. When systems reach their limits, they don't adjust gently. They reset violently. We're not saying silver will explode tomorrow. We're saying the foundation is cracking. Cracks don't repair themselves when demand keeps pressing down. This is why watching price gaps matters more than watching price itself. Because price can be managed. Spreads are harder to hide. As we move forward, keep one thing in mind. Every time you see silver sold aggressively on paper, ask where the metal is going. Every time futures prices drop while physical premiums rise, ask which market you trust more. And every time someone tells you silver is irrelevant, ask why governments, industries, and entire regions continue to secure it quietly. This channel, Global Silver Truth, exists to ask those questions out loud, to connect the dots others pretend aren't there, and to help you see the market not as it's advertised, but as it actually operates. If this breakdown helped you understand what the CME versus Shanghai price gap really means, I want you to do two things. First, share this video with someone who still believes silver trades in a perfectly free market. Second, drop a comment below telling me which side you trust more, paper pricing or physical demand. I read every comment, and your engagement helps this message reach more people who need to hear it, because the silver market didn't expose itself overnight. But now that the gap is visible, it can't be unseen. And once confidence breaks, it doesn't come back easily. Stay alert, stay informed. As always, stay grounded in the truth.